Welcome everybody. I'm Sanjay Vora, CEO of Avestor, co-founder, and I'm super excited to have Peter Snell on. Peter is the CEO of Petrovybe, and he's a deep expert in the oil and gas industry. And so maybe, Peter, if you can just give us a little bit about your background and kind of experience in the oil and gas industry, and then we can kind of jump right in and help people understand kind of the industry and the deals and how everything works better.
Sure. Yeah. So thanks, Sanjay. So glad to be here. Let me give Sanjay a shout out, since we're doing Mutual Admiration Society here. I love what he's doing with this business at Avestor. He has an incredibly innovative mind and model for something that's very difficult and complex for businesses. He lowers the bar for entry, which I think is great. That's good for everybody. It's very American. So I love that about Sanjay, and I've really enjoyed working with him. For me, the headline for me is I'm a disciple of Jesus. I'm a longtime business fixer, and I got into the oil business a few years ago, helping a friend fix his business, and that took me to a place where I really fell in love with oil and gas. I got to know a lot of people in the business and ended up hanging out my own shingle, if you will, with Petrovybe. And so I've partnered up with some really great folks. Love the business. Spent a lot of time drilling wells and raising funds, and looking forward to just sharing some information about things that I've learned. I certainly am learning every day, so I'm as much a student as I am a share of information and knowledge. So excited to be here.
Awesome. Thank you, Peter. I appreciate the shout out.
Yeah,
so let's start at the most basic level, even for me. I mean, I don't understand this industry that well.
Sure.
Just kind of, how do the basics work? Like from a oil and gas perspective, the industry, how many, and not talking about the big players, like the massive Exxon type guys, but smaller players like you guys in terms of, how do you guys find deals? How do you structure deals? How does the industry work as a whole before we start getting into super details?
Yeah. I think having some context about the industry, maybe some fun facts. One is, and this was a surprise to me, I read this last week, the super majors, your Exxons, your Chevrons, they represent about 13% of the total production output of the entire oil and gas industry.
Wow, that's it.
That's it. It's mostly
absolutely crazy.
I know, it blew me away. I didn't know that either, but there is sort of a misunderstanding out there that they're the ones, and certainly they drive things and, multi-billions of dollars and so forth. You've got Saudi Aramco on, on a global scale that is really the largest oil player in the world. But you look at this and the players like, the mid majors, say an EOG, for example, and some are middle tier, like they're large, from the scale of large corporate players, they're large, but then you have smaller players as you scale down, and the industry is really made up of producers that are, small like us. We're small and independent, nimble, on up to the super majors, and most of the production comes out of those multiples of companies, and it's a really it's sort of a familiar industry. There's it's difficult to enter, but there's been a lot of innovation. So there's been opportunities, niche opportunities in the industry for production. That's really how Petrovybe got started. There's just things that are still being missed. And in context of, there's always this data point that's been coming out since the 50s, where they say we're going to run out of oil in 20 or 30 years. And the goalposts on that get moved every year. And the reason why is because the innovation and technology improves, in addition to the fact that we just don't know what we don't know as an industry. And there's so much oil that even in current fields, which is one of the things that we, ourselves like, is there's a lot of fields that are proven but underdeveloped. They just don't have, they've only harvested about 10% of what's in the reservoir. So when it comes to like scale of opportunity, there's still a lot of opportunity, and the world runs on energy. I mean, Sanjay, you look at your jacket. Let's take your jacket, for example. Petroleum products all over, not just in the production of it, but actually in the synthetics that are made. There are petroleum products that go into the chemicals that produce those things. Your glasses, you see the stuff in my office back here. Yeah. Petroleum products are everywhere. They're all over our household. They heat our homes. And one thing I did want to, and I'll kind of end here because I don't want to get too much on a rant about this, the macro view, but you think about, there's a lot of confusion in the world about the difference between, people talk about EVs, right? EVs, you've got, and by the way, that's great. I mean, I'm an EV fan. I mean, I think electric vehicles are awesome. And I'll get to why in just a second, but there's a difference between source and storage, and EVs are storage. Now, it still takes natural gas and coal to power the plants that you plug your electricity in to get your car. So I always kind of laugh because, yeah, the emissions aren't visible. You can't see them coming out of the tailpipe, but it takes approximately 885 barrels of oil to produce one Tesla battery.
Oh my gosh, that's crazy.
Yeah, so there's a lot of sort of, the world runs on petroleum, and there's the industry has gotten so much better at doing that profitably and smart and environmentally safe. And we could go in a lot of different directions, but that's sort of a large scope of what's going on. Us as a provider, small independent providers in general, are trying to basically create value in those niche areas that can make things available to investors, to ourselves, obviously, as well. We're investors too, in order to create value and profits. And there's still a lot on the table. We're a long way away from, literally, not in my lifetime. I'm 51, not my kid's lifetime. We're a long way from harvesting what's in the ground. So
cool. So tell us a little bit, tell me a little bit about kind of, how do you go from the stages of the projects at the high level, from identification of an opportunity to analyzing that opportunity to then what's next? You raise capital for the opportunity, you go, and how do you deploy the capital? How long does it last? Just kind of walk us through a project in the oil and gas industry and the business plan that goes kind of with the project.
Yeah, so the best thing to always do is start with the end in mind. What's your goal? What are you trying to accomplish? Are you trying to, what kind of returns do you want to achieve for all partners? You're going to need capital to do that. It is very expensive to drill wells. Even inexpensive wells are millions of dollars. And so when you think about that, you've got a high bar as far as capital requirement. And there's, so you have to keep those things in mind. What is it that you're trying to accomplish? And most of the time, when you think about looking at a project, what you want to do, particularly in the oil and gas business, you need to be cognizant of not just what the return is, but what's the risk to achieve the return. It is a historically high risk business that has really developed with a lot of trial and error. There's a lot less trial and error today. So as we think about a project, first, we want to say, okay, what kind of returns do we want to get? What kinds of capital are required to get those returns in areas that we think could deliver that kind of value? And you have to essentially go out, and there's a lot of depth to this, but you have to know the right people in the industry, from the perspective of, there are guys that produce deals. They understand what prospects are. So when I was talking about prospects, it's actually going out and looking at leasing people's land to harvest the mineral rights. Okay. And there is no shortage of deals for leases. Like I get an email or a phone call at least a couple times a day with somebody who's pitching me a deal where there's an opportunity to go harvest minerals, and you've got to lease the land, right? You don't actually, when people talk about buying acreage, they're talking about buying the rights to, a little different than real estate, right? You're not buying real estate, you're buying lease rights to go and drill. Now that gives you, the way lease contracts work, it gives you a great deal of depth in your ability to operate on that land. It limits the owners and their ability to impede you. And hey, I got a thumbs up. It eliminates or it limits the owner's ability to impede your ability to actually do the work that's necessary. And so a lease is a very powerful tool. And really and there's strategy in that, like, is this the right field? And I could speak for how do you determine that? Well, you need to look at some key things. And this is part of the underwriting process. And that's one thing, when you think about oil and gas, it's really important to when you're considering a project to invest in or anything. We can talk more about this later, but for us, it's really, we're underwriting, right? We want to know, do we have the opportunity? So we're underwriting to understand what kind of geological data do we have? What kind of what we call well control or well data do we have of wells that are drilled in the area, or if they're not any, how close are they in proximity to the area that we want to focus on? And then what's the reservoir, the estimated reservoir value in the area that we're looking at based on all that data? And there's really advanced ways we call 3D seismic I'll camp on that for a second. 3D seismic is a great way to analyze the value of the hydrocarbons, the minerals in the land. Think of it like a sonar. You know, if you think of a picture of the weather, right, and you see the big pink and red and orange and all that's coming in, you know, the storms coming in. Well, the 3D seismic is a high-tech way for us to see underground and really look at where target areas are and what's actually available. And you can cross-reference that with other well data to understand what does the reservoir estimate to give us. Once you determine all of that valuation through the data, then you can start doing the economic modeling and determine based on a number of factors about how much it's going to cost to go get it. And there's a lot to leasing costs, to land development. How close is infrastructure? That's really important. What's the cost? If you're in a really remote area, things get a lot more difficult a lot more quickly because your costs go up. So it makes profitability more difficult to achieve. It's still just like in real estate, location, location, location. That's true when you're developing this kind of stuff as well. If the infrastructure is there, that helps you keep your costs low. But finding sort of diamonds in the rough of an area that's already been developed is a real unique.
So here's a question. You mentioned you got a lot of phone calls from people wanting to lease you the land. So you guys, who's responsible for running the analysis? Do they do the analysis and then you review it, or you go and do the seismic analysis or whatever the analysis is you call yourself and determine, which ones are really good properties versus bad properties?
Right, both. So they're going to give us some of that data, some of it they won't. Some people have a lot of depth. So some people that are selling you a project or a prospect, they've already done a ton of analysis, and they're trying to give you enough to essentially lure you in for more conversation. And as they do that, they're focused on providing enough information to get you interested and potentially give up some capital, and then they'll open up the rest of the doors. We do our own analysis. And there's levels of cost to that, right? Underwriting at the level that you have to really understand the prospect. That's where some of the risk management comes in. So it's both, but you have to underwrite your own deals. You don't go into a deal without underwriting it first. That's really critical. And there are stages. We underwrite before we go into a deal. We underwrite in the middle, and we underwrite all the time. Underwriting is like a constant theme in oil and gas, or let me rephrase that. It should be. It's often not, but for example, that is paramount. The only way to be a good steward of your capital is to make sure that disciplined underwriting is a constant theme inside your business.
Okay, got it. So then let's say you found a great opportunity and now you're going to go raise for it. What's the general size of the opportunity usually you guys go after, or you're planning to go after here? And then what happens then? What's the next set of stages of the project?
Yeah, so as an oil and gas operator, manager, what you got to determine is how much of that can I pursue in what stages? So one of the things you want to make sure you do is think big enough that you can develop real opportunity, but think small enough that you can consume it. So
Right.
it's a real balance there, and you've got to have the asset to support that. I get deals that come across my desk all the time that aren't worth the paper they're written on, as far as like, high upside. It's most of those deals that are smaller are more difficult to accomplish. What we like to focus on is fields that are, again, they've already been proven. There's hundreds, sometimes thousands of wells already drilled, but they've only tapped into 10, 12, 15% of the reservoir. So there's a ton of oil left, and we can stage it. And nobody knows about it because most of the big boys have left the area, and they took their data with them, and it costs a lot of money to get that data. So you have to be you have to be able to get to the right people in the right timeline in order to understand, this is that diamond in the rough. And so that's really what we look at. Like, we like projects that, our entry point is somewhere south of $10 million. Like our current project, we're already vested in that at $10 million. That's all in the research and the development, understanding the prospect. I mean, there's been a decade of work done to get to that, a lot of investment. We came in at the right time. So that's a $50 million capital raise for that project, but there's a big upside to that, but you gotta balance that. There's a lot more in this opportunity that we could raise for, we could pursue, but we need to bite off the amount that we can consume and deliver returns for all partners. So that's where it starts. That's kind of the initial investment. And then, and you obviously raise capital to go out and develop that. And it takes time. That's the other thing that's kind of, it's not like you buy a building and you think about dressing up a building that's dilapidated. It's going to take some time if you're in a multifamily or commercial situation, and then, increase rents or put more people in it. Much like it's going to take time. It's going to take time in oil and gas. It's not like, you buy it and instantly you return value. It takes, 18 months to really see any real return of value.
So from the time you you start the investment process, you have to then go get all the equipment, get it installed, get it up and running. So that's about a 18-month projection, and then the oil starts flowing.
Yeah, so it depends. You can buy assets that have what we call PDP, or proven developed producing. Those are just wells that are already producing. So you can buy that and you're drilling around them. That's one way to do it. The other way, which is like the project we're working on, is we actually have two projects going, but the one that we're focused on first here right now is you really want to focus on developing stuff that doesn't have PDP. And there's two ways to go about it, really. If you have current income, that's certainly a way to do it. But what you really want to do is whatever income you're producing, if you want to scale your value, what an operator needs to do is take as much of the cash flow as they can up front for a period of 12 to 18 months and pack it back, not just raise capital, but use cash flow as capital for drilling. That's where value comes from. Value comes from drilling. So whether you buy a cash flowing asset that you want to expand, or you buy one that's not cash flowing that you're going to develop, put the cash flow from initial drilling and any cash flow you have back into producing new wells, developing new wells. And that's how you're going to get scale in value.
Okay. All right. Got it. So, then once the flow of oil starts coming, how long does is it all at the beginning? Is it kind of varies over time? What is the stream of the oil look like, and how does that then translate to cash flow?
Yeah. So realistically, it's, first oil from, it depends on where you start your timeline, right? But let's talk about, okay, so if the capital is deployed in January for producing on an already leased area,
Mm-hmm.
you have to create construction, build up for your infrastructure, or at least prepare for that, and begin your drilling. Actually drilling a well, particularly in vertical wells, it doesn't take but sometimes a few days. Even 8 to 10,000 feet, it may take you 7 to 10 days to drill the well.
Okay.
It may take you another 3 to 5 days or 10 days, depending on what kind of a solution you're doing to frack a vertical. You get into horizontals and you throw that all out. They take a lot longer. They're a lot bigger. They're a lot more complex. You have directional drilling. You have science you're doing downhole. It's a whole different animal. Vertical wells are simpler. They also typically less risky, but typically they produce less. The reason why people are going horizontal is because the upside is so appealing. So,
Sorry, when you say horizontal, what does that mean? Like,
so you enter the ground, simply you enter the ground, and then you basically start a curve, and then you cut across the formation for a mile, 2 mile. They're doing 3 mile horizontals.
oh wow.
So you actually drill horizontally. If you think about a drill bit just going into the ground and then making this turn and going horizontal, that's what it is.
And it's because you can now just pick up all the oil going horizontally, which the vertical drill doesn't capture.
Exactly. You get economies of scale, and each foot you drill is less expensive because it doesn't cost you really. I mean, the further out you get, the less expensive the drilling cost gets. That's like a whole other ball of wax. And there's value in both. Like there's plenty of vertical applications out there that will make money, really good profits. There are plenty of horizontals that will be profitable. And I can't remember where we got started on that, but I'll say it's real important to know what there are different kinds of plays, if you will, different kinds of formations under the ground. You have conventional and unconventional. Conventional typically use more of a vertical application of drilling. But your question, back to your original question, what's the timeline? If we're able to start construction on the pad where we do the prospect and you're going to potentially drill multiple wells, could be several hundred acres in a vertical application, you're going to be somewhere around 60 days before you from construction. And it depends on where you are, what kind of rock you're drilling, how deep you're going. But conservatively, you're at 60 days before you see oil. And you're typically about 4 to 6 months before you see a return in cash flow. That's a safe estimate. You can go quicker, you can go slower. There's some wells it's going to take. I mean, some of the really cool exploratory stuff they're doing out in the ocean and other places, timelines are a whole different thing. So,
okay, all right, got it. So now, let's talk a little bit about switch gears into the actual investments. And talk a little bit about how does the oil and gas investment work? So somebody puts money in, and then kind of how long do these investments last? When, what does the income look like? How does it, just if you can walk us through kind of a typical oil and gas investment.
Yeah, I didn't mean to chuckle a little bit when you said typical. I've never seen one, but and that's because a lot of people in the industry look at things differently. But to give you some basic structure, essentially what you're doing is years ago, decades ago, millennia ago, actually, the United States government gave the citizens an incentive through the tax code to invest in oil and gas, because it basically was tied to the wars. They needed more production, and they wanted the American wealthy to have an incentive to drill wells. And the technology back then, a whole different, I mean, to call it technology would be an overstatement, but they wanted to incent people to do it. So they gave these basically intangible drilling cost IDCs. Some people may have heard of that, but those IDCs are very unique because it's an incentive unlike really anything that you can get. The bar is relatively low for the investor. Invest $100,000, say, to into the program, which and you're going to get anywhere from 60 to 80%, sometimes as much as 90% of your investment as a deduction through a K-1 that you can take against ordinary income. And you don't have to be in the industry to do it. Like in real estate, you kind of got a bar there, and that you have to like prove that you're in the industry. But that's how the tax benefit at a very simple level works. It's up to the operator to be able to create those intangible drilling costs, and that's an art and a science also. but just to get a little snippet of what that's like, you think, well, geez, what's an intangible? It's mostly services, right? They want to incent people to invest in the oil and gas development for America, which there is nothing more American than drilling for oil and gas. But it's interesting what you classify as an intangible drilling cost. You think let's look at drill bits just as an example. Well, drill bits, you'd think, well, that's a tangible drilling cost, right? I gotta buy a drill bit to drill multiple drill bits to drill a well. It's not. It's actually an intangible drilling cost, and the reason why it's intangible is because you lease the bits. You don't buy them, you lease them. You have a drilling company who provides you a service with their equipment, and we as a drilling operator, we get to take advantage of the tax break there because we're not buying the bits. It's not an equipment, it's a service that we buy. So it goes in the intangible bucket. So the industry has gotten very creative in being able to maximize IDC deductions that you can take against your ordinary income, which high earning W-2 wage small business owners, big business owners, executives, people who earn a lot of money and they're sitting around with a pile of cash, they like oil and gas investments because it gives them an opportunity to reinvest in something that has some long-term upside, some short-term upside potentially, and it gives them an immediate return on their money that otherwise they would have to pay the IRS. And so, yeah, you were going to ask.
Now, so let's come back to I had quite a few more questions around the tax side of it, but let's come back a little bit to the investment itself.
Yep.
So you make the investment, let's say it's $100,000 investment. Then it sounds like there's a period that there's no cash flow, right? You get the depreciation, but there's a period there's no cash flow as you're starting the project, and then the cash flow starts. And then how long does the cash flow go for?
Yeah, so the target, so on a $50 million raise, let's say you're drilling, you could drill anywhere, depending on how you scale your strategy, you could drill as few as 15 wells and as many as 50. But let's say that you're raising $50 million, you're drilling these wells, your project horizon for drilling based on a scaled model, which is where you're taking cash flow each year, and it scales down each year. The first year, you're taking all the cash flow, putting it back in for more drilling, and then you scale that down a little bit and you start giving distributions. That's how you get to a bigger end. Right. But that's the smart play. There are programs out there where you can get some modest cash flow early. There's a lot of companies that'll sell you, and this is in this model, you're investing into a limited partnership that owns that's developing an asset. That's different than buying into what we call a wellbore assignment, where you're only buying into the oil that's produced out of 1 or 2 or 3 wells. In this model, you're getting not only the cash flow, but you're getting an opportunity to take advantage of being able to sell the leases or the opportunity to continue drilling for a multiple to another operator down the line. So there's a lot of potential multiplication on top of your multiplication in a model like this. When you think about how your investment works in this model, you're setting aside cash flows early so that you can get a strong 5-year play. Now, in a smart model, you're going to drill for the first 3 or 4 years, and then you're going to cash flow it as long as you can. The good thing is you can cash flow very profitably, well beyond 5 years into 7, 10, 12, 15 years. Typically you see it's a declining asset. So if you don't keep drilling wells, at some point you're going to peak and that's going to start to fall off, but you're way into profitability. And one thing I love about this, it is truly passive. Not for the operators, obviously, but as far as like, if I'm an investor coming in, there's not much I either can do or need to do in order for this to play out. It's really pay attention and hope the operator knows what they're doing, that they've got a good track record, and that they've done their homework, that they remain disciplined, that they are transparent about challenges, and that they celebrate the victories. And so those are the kinds of things that you think about as an investor that are important to getting this 5-year window. But the question you asked was, it's a 5-year window. You drill for the first 3 or 4 years. And then here's the great thing: the partners can decide later down the path, hey, do we want to start reinvesting cash flow again or bring more capital and do it over again? Because the field has a whole nother tier of play. And if you do the right play, you could do this for 15 years with the same recycling in 3 different phases. It really, that's why it's so important to do your underwriting, be disciplined, make sure that you're good stewards of your capital. Stewardship is paramount. And I would say biblical stewardship. That's a really important topic. I would love to get to that if we get time. So.
No, that sounds good. Okay, so let's jump into a little bit more of the nitty-gritty here. So these investments are set up, unlike typical real estate or other investments where they're set up as limited liability companies. We're setting them up as it's a limited partnership structure, like the fund you're setting up right now. And inside of that limited partnership structure, you've got a managing general partner, right? You've got a general partners, and then you've got limited partners. Can you talk a little bit about kind of the roles of the managing general partner? Then there's the general partner, and then there's the limited partners. Most of the time, most investors are used to the manager member or GP-LP structure where you've got kind of the manager and then they're the passive investor. Here, kind of how does this work? Because you're getting to offset against active income back to the tax part of it, but you're a passive investor. And so talk a little bit about the structural model of and how it actually applies.
Yeah, that's a great intro to what it looks like typically, and it's different than real estate. And the reason why is because the tax code treats it differently. So if I'm an investor, let's look at it through an investor's lens. I come into this deal, I've got to come in as a GP. And by the way, let me throw my disclosure out there, which is I am not a tax professional. I'm not an advisor. Seek your own tax professional for advice on this. And I will tell you, there are a lot of CPAs who have no idea how this works, and there's a lot that do. You want to make sure you got a good guy. But anyway, so the way the code works is you have to come in as a general partner in order to achieve as an accredited investor. You have to be a GP to come in. And the reason for that is that's the requirement in the code in order to take the loss as a partner. You can't be as they would define it, even though your activity is passive, they want your status to be, government never gives you something without taking something, right? They want your status to be one who has something on the line. And so that's why you have to come in as a GP. What we do as a partnership, or what any good operator should do, is as they develop, the tax benefit's just something to get you started. You want a profitable project. So you want a tax problem again later. You do. Nobody wants a tax problem, not really. But the idea behind that is come in as a GP, and then once the partnership no longer can produce a paper loss, you flip into an LP. So the idea is not a long-term situation. Typically, that's going to be a year, maybe 2, if the program's not doing exactly what you hoped it would early. But bottom line is you want to have you come in as a GP. It doesn't change your role. You don't have managerial duties or responsibilities. Some people have concerns about the liability. You can buy your own liability. I was going to ask you. Yeah. So we have insurance. We do. Other good operators, you're going to have insurance. You're going to have general liability. You're going to have environmental. You're going to have errors and omissions, a professional liability for your decision making. And you got to make sure that your whatever deal you're getting into, that your operators are doing that they have that in place. You as a partner are part of the partnership, so you're already, as a general partner, you are automatically a named insured and covered under that. I have seen some partners historically go out and get their own $1,000 a year business policy, general liability business policy, to cover their potential liability. Now, again, not an insurance agent. I don't know if that really works. I know what we buy works, and it works for the partnership. So
the insurance you guys buy, because as a GP investor, you do have unlimited liability, right? And so the insurance you buy covers it covers both the managing GP as well as the GP itself, all the GPs.
Correct. And so, and the way you structure, there are layers in the way these are structured, right? It sometimes can get confusing, but it's pretty if you just stop for a second and don't go too fast, you have a managing GP entity, and you have an operating LLC that's doing the operations, arranging vendors, operating the development, and then you have your LP, which is the entity that owns the assets. That's where the value is. The value is inside the LP, and you need the LP structure for the tax stuff to work. And that's when people come in, they're GPs I know it says limited partnership, but you're just coming in as a GP, and then you're going to flip to an LP after things get going, usually around a year. So,
okay. So, and then if there's additional depreciation that's flowing through from IDCs, you have to stay in the GP role if you want to take advantage of that, right? So is it because if you flip, you don't get the advantage, you get the cash flow portion of it, but you won't get the IDC portion of it. Is that correct?
Right. As I understand it, you're to take advantage of these tax deductions. That's the other thing. It's a little bit of the rub is I don't want to be in that bucket for very long. If we're only in that bucket taking tax deductions, like there's limitations that the government puts on. You got to be 1,000 barrels a day producer or less. So if you're under 1,000 barrels a day, I don't want to be 1,000 barrel. That's not what we're trying to do here. We're trying to produce quite a bit more, tens of thousands of barrels of oil a day is what obviously if you got the right project for that. So there's a window where they're doing this to encourage to support the small operators to get off the ground, and that's how they can incent the capital raise. So there's a window there for the tangible drilling costs and then the depreciation that you talked about as well, and that will carry on through time. I do believe you got to remain in the GP status. Most people that I've worked with in an accredited investor basis, they're typically they have a higher tolerance for risk, and they understand how insurance works, and so they go, hey, look, I'm covered on the insurance. And then you got to look at what's going on in the field, like how many lawsuits are going on, how many environmental issues. 99%, that's not an exact number, but most of the issues are, a saltwater disposal, which is a whole nother geological thing, but saltwater disposal well breaks down and kicks up salt all over somebody's 200 acres, and you got to go clean it up, and it costs 50 grand or something. Those are the lion's share of your environmental issues. Doesn't mean there aren't that happens with older wells. That's an example of common things you'll see there. So, but there's just not a lot. There's so much technology and so much regulatory oversight with safety in this industry. Doesn't mean things don't happen, but it's rare anymore.
Okay, got it. And I would assume that if you came into the fund with an LLC structure, and I know you're not a tax professional, but I'm just, and everybody should go ask their own tax professionals, but the LLC would just get the pass through of the investment into the fund. Is that correct?
Yeah. So, and I will say this, are you saying if somebody comes in as an entity, like an LLC entity?
Exactly. If they come in as an entity because they want the additional protection versus if they come in as a GP directly, then they're personally have liability, versus if they come in via an LLC that they've created, either an individual or multi-member LLC, then the LLC has the liability, but they get the additional layer of protection, right?
Yeah. So there's value in that. I'll tell you, there's some technical rules around that. As I understand the code, you can't create an LLC for the purpose of making this investment, whatever investment you're doing. Yeah. Okay. Now, certainly you can create and you can do an entity to have any lawful business purpose that you desire, and that can be one of the mission parameters, right? But in the case that something ever happened, that's something, like anything, it's a good way to create some protection. It's not fail safe, I would say, but for example, when I've invested through my own LLC for the very same reason. Another thing that you got to remember, though, is any member that is in the LLC must be an accredited investor. So that there's been some folks who've said, hey, I've got family that I want to bring into this. Well, you can't use that LLC if they're members because they're not accredited. So you could certainly make your own arrangements. That's none of my business, but there are other ways to do that where you can make arrangements through a business transaction with family members. But the LLC members have to be accredited, all of them, 100%.
Yep.
So.
Yep. Makes sense. Or the LLC has to be over 5 million in assets, right? Then by default it becomes.
That sounds. I don't know. I'm not sure. That one I don't know. So I defer to my tax guys for that
one. No, that sounds good. But then you've seen in at least with the investments you've seen that then that tax flows through to the LLC.
Yeah.
Okay. All right. Gotcha.
The tax savings flows through. Yes.
Yeah. The tax savings flow directly into the LLC.
Right.
Okay. All right. Got it. Now back to the investment itself. Is there an exit date, or how long do these investments go? And like the fund you're about to launch, tell me, let's maybe we get into the details of that fund.
Sure.
Talk a little bit about what your plans are around the fund you're about to launch.
Yeah. So, and I'll try to keep it as general as I can, because, we obviously we're fundraising. We want people to come into this, but only if they believe in it and they want to be there. I mean, there's not a hard sell here. You got to believe in the project. Obviously we do. I mean, we're, a Texas born American oil and gas company. I mean, we love what we do. We want to drill wells. We want to deliver. We think this provides value to not just to our families and our partners, but also the American economy at large. When you think about a date, the exit opportunity. So you want to look at the project back at a 5-year timeline. That's a realistic oil and gas program project timeline or time horizon. Again, you can extend out past that with just taking cash flow. There's a lot of factors that go into, are you able to do that? What kind of drilling and hydrocarbons are you pulling? So we like liquids, which are both oil and wet gases. And we like that in predominantly gas fields because the maintenance costs are lower and your profits are higher. Long term and short term, you basically have, it's a risk mitigation strategy. And so, you're always going to have commodity fluctuations, but back to the timeline for an exit, there could be an exit as soon as 2 or 3 years. If the market, like, you don't have to go exactly as the plan stipulates. If you're doing a good job and you've done your underwriting and it's paying off, and you continue to stay disciplined in your underwriting, you're disciplined with your cash flows, you have the right reserves economically, you can go and get a multiple faster. It is realistic to think that that's an opportunity. What is not realistic is when is that going to hit? And that's why I can't tell you, like, in oil and gas, and anybody in oil and gas will tell you it's as much timing as anything, right? And you could get in our project, for example, there's nothing in that respect. Like, I'm not looking for an exit in the first 2 years because we just don't have enough value built up for an exit to make sense to investors. Now, at the end, 18 months, 2-year mark, we will have something we could talk about, but it's not really where you want to be. It really, when you get in that 3-year mark, that 4-year mark, then you're starting to look at, hey, is the market offering something here? Can we, so like our forecast for the project we're working on right now is 3.26x. It's a conservative number. Again, stewardship in the underwriting is critical, discipline. But if we were able to go and get that inside of a 3-year model instead of a 5-year model, because right now that's just a cash flow number. 3.26 is it's an EBITDA distribution based model where you get through the 5th year and you've done 326% on your money. Well, if you can go get an exit that can take you to 3 or 4x before then, of course you would consider that, and I would say we would take it. That's an opportunity. One of the things that about our project that I like is I don't have that pressure. We have an incredible opportunity where I don't have to rely on an exit to get a strong multiple. It's not necessary. It's a bonus. I did do the math, and if you do the math at the end of the 5th year, when we're projected to peak, you're going to have potentially a 6x multiple if you can get that divestiture. Right now, I have no idea what I'm going to be doing in 3 years other than this project, much less 5. So I wouldn't put the probability at a 6x in 5 years. I would put it under 50%, well under 50%. Ask me again, though, in 2 years.
Yeah. But so if you put aside the tax benefits, which are huge,
Yep.
what would be the estimated return on capital date? Like when would you get the capital back?
So I'm going to make sure I answer this right for my CFO, because I'm sure he's going to be listening if he isn't already. But I believe that is, I want to say that it's at the end of year 2 or middle of, so it's around 18 to 24 months.
18 to
And
24.
then it hockey sticks.
Okay.
Like you're starting the hockey stick, and then like your first year. So, and by the way, this is that 3.26 multiple is net of the tax benefit. So you get the tax benefit, but you shoot way.
Yeah.
So
Exactly.
it's a cash flow based. It's not the tax benefit, which is nice, by the way. That's designed to get you through year 1 when we're piling into the scale, right?
Yep.
You take a good operator is going to take that cash flow and pack it back in, and the tax benefit. If you look at it, like we did an analysis, and this is just not a tax professional disclaimer, but if you look at it, there's if you take the deduction for somebody who's making $400,000 in a year, you take a 70% deduction on a $100,000 investment, so they got a 70K deduction, and you do the math again, put in their normal deductions they're going to get, and you do the math all the way down. The savings that you get on the taxes are a cash on cash annualized equivalent of 21%. So you're starting with 21%, right, almost instantly. And then you're going to year 2 where your real cash flow forecast is 33%, then 65, then 89, and then 139 in year 5. So you can see the hockey stick really start to and the reason you're able to do that, and it doesn't come up high and then just kind of do this and then dip down, which is what the wellbore assignments of people who are pilfering their programs to pay cash early to sell their deal, which you don't want to do. You don't want to pilfer your deal by giving away cash flow early, because you'll never get off the ground. You're gonna sputter and make abysmal returns, dilute investors. It's really tough. I've seen it. Unfortunately, I've been around that. So it's real important to make sure that you've got, again, a biblical stewardship is taking good investment. And I want to camp on this. Forgive me, like 60 seconds to talk about this, because it's at the core. It's the deepest part of my heart, and it's at the core of the business that we're doing. And that is the lesson that I've learned from Jesus in Matthew 25. He's telling a parable. It's a story. But he's telling the parable of the talents, and he's talking about basically the master who gives 3 of his servants. He's going to go on a journey. He's given 3 servants talents, and talents are it's basically money, right? And he's giving them this. One guy gets 4, one guy gets 2, and one guy gets 1. The guy that gets 4, master goes, he comes back. The guy that had 4 doubled it. The guy that had 2 doubled it, and he gave him more. He was like, "Well done, good and faithful servant. I'm going to give you more." And then the last guy buried it in the ground. And he said, "I was afraid of you. I know you're a harsh man." And he goes, "I'll take the talent I gave you." And he cast him into the outer darkness. That's a real thing. And even though it was a story, and he gave that talent to the guy that had 4 talents. So the lesson there is it's not our money. I view this all as God's money, and then other people are managing it. These are investors' funds. They're my funds too. I'm all in on this, man. You got to have skin in the game, but not only that, you got their skin in the game too. And so you got to treat it in a way that it's God's money. And if it's God's money, then I'm looking at it going, okay, there's no way but to be disciplined, humble, sharp, take good care of that money, make it work for itself, build on itself, and then you can start patiently. Then you can start paying people the value. And as long as you're transparent in what you're doing and communicating well on a regular basis, that's the kind of thing that people, I think, will believe in. I certainly did. I think it's
awesome.
going to be a huge part. So
no, that's awesome. I love it. It's great. So what, I guess I have to ask the question, there's risks.
Oh yeah.
So, it's a risky industry. The projects can be risky. Can you talk a little bit about what are the risks for an investor? What are the things that, that keep you up at night? What are the things that an investor, if this scares them, maybe this may not be the right investment opportunity.
Yeah.
What are some of those things in this industry?
Yeah, so there's a lot. I mean, our in our PPM, and I probably shouldn't say this because it doesn't sell, but I don't care. You should know it anyway. I mean, our risk section is like, I don't know, 10 or 12 pages, something like that. It's pretty robust, and you could say that for a lot of startups. This is oil and gas. There's risk, but the greatest risk, the number one risk, is commodity prices. It's the volatility. Now, that's what the industry says. I generally believe that. I will say that if you look at any kind of historical window, 5 years, 3 years, 10 years, commodity prices are in a very profitable range over time. But if you get caught in a cash flow problem as an operator, you could certainly get crunched by a pandemic. And a lot of people lost their shirt during the pandemic because they weren't prepared, because they weren't being good stewards. So if you're being a good steward, you should be able to weather the storm like a pandemic. It's not everybody can or did, and it wasn't, it's not always somebody's fault that happens. But the commodity prices are a risk. You also have a risk if you don't have good data. So one of the things that is really critical to disciplined underwriting and to this concept of biblical stewardship is the fact that you use really good data. You need to understand as much as you can, as much as money and time will buy you, to understand when you're above ground what's under the ground. And that means that all the things we talked about before with 3D seismic and well control with other wells around there, how close are they? Are they nearby in proximity? What can you learn from all of that? Data is, and really not just the data, but understanding the data at as deep a level as you can is really critical to mitigating the risk. If you don't have a lot of data, here's the other thing, just to give you a quick list: track record. Check an operator's track record, get to know their history. What have they been able to accomplish? It's a tough business, but what have they been able to accomplish in their efforts? So I think team is a huge risk factor. It could be a great reward if you have the right team, right? But there's the other side to that. The other thing is it wildcatting, or is it proving up an unfinished field? When I say wildcatting, that's, hey, there's not a well within 15 miles. We have good data, but we don't have any real wells to nearby wells to really analyze, and so that could be problematic. Those are things that are of greatest risk. There's obviously regulatory risk. People can change the rules on you. You certainly have environmental risk and things like that. I do find it interesting, if you go back up real quick to the macro view, the industry faced a lot of pressure and a lot of downturn in some respects, or flattening, if you will, where oil companies were taking profits. They weren't focused on growth. They were focused on profitability, which is what they should do both, but really first profitability. It was good for their discipline. But what's interesting is there was this huge craze for ESG. And by the way, we should be thinking responsibly. We should be acting responsibly, no question. But to make a bum rush towards ESG that has proven to not be profitable, and now that's what's happening. Everybody has spent trillions on ESG initiatives, and the funds have seen their people leave in droves because they can't make money doing it. They're even changing the way they market their funds and adding traditional energy sources back into their funds when you look at the macro investment environment, because they can't keep people around. People are going back to traditional energy because we are a long way from leaving energy that's provided by oil and gas.
Awesome. I know we're running to the top of the hour here, and I'm not sure if there's any. I know there's one question I see in the Q&A about, can working interest be passed through the fund-to-fund investors? If so, what's the structure required to accomplish this?
Yes, the answer to that is this is a great question, Kent. Thank you. I don't know if Kent's still with us, But yeah, I can't. The answer is yes. Basically, it's an LP to an LP model. So we have a fantastic tax attorney who knows how to do this. He knows how to structure it, and that's how we do this model. You've got a master fund LP, and then you've got a project LP, and the tax flows directly through to that, and it's absolutely possible. It's actually quite simple. It's one of the reasons I partnered with Sanjay so that we could take advantage of that innovation that he put together. So,
Awesome. All right. So I'm not sure if there's any other questions. Do you want to just maybe Peter in the thread, if you can just throw your email in there, and
sure.
if anybody wants to reach out to you, I think that'd be super helpful. And then if you have any other final thoughts here, I'd love to just kind of hear about them, and why you're so passionate about the industry. And
yeah, I mean, I don't think there's yeah, I'm just grateful that people wanted to come and listen and learn a little bit about oil and gas. Hopefully, man, my head's swimming just because there's so much I could talk for hours about this, but it's a lot to consume, and I'm just grateful everybody was here, and I appreciate Sanjay you hosting this and giving me a chance to talk about something I really love doing, and really grateful for that. And if people are looking for an opportunity to pay themselves instead of the government here with some cash sitting around at the end of the year, we have an opportunity for that. And so you can reach out to me, Ryan Turner and Grace, my team. If you've got interest in doing that, we'd love to. If you believe in what you're hearing and you want to pay yourself instead of Uncle Sam, certainly reach out to us. We'd be happy to help. So
awesome. Thank you, Peter. I really appreciate you coming on and giving us an overview of the industry, the investments, how it works, and everything. It was fantastic. I learned so much in this hour, way more than I ever understood from the industry perspective.
Awesome. Great questions, man. Thank you, Sanjay.
All righty. Well, you have a fantastic day, Peter, and I think we'll wrap this webinar up.
Sounds good.
We'll talk to you soon.
Okay. Thanks, Sanjay.
All right. Thanks, Peter. Okay, bye-bye.